Good evening and welcome to the Money Show, the show that puts your money matters front and center in a world full of financial noise. We are here to bring you clarity, confidence and control over your personal finances. I'm Kavita Thapliyal, and on this show, whether you are planning for retirement, building a portfolio, navigating debt or just trying to make smarter money decisions, this is your space, your guide and your weekly check-in with your wallet. Every evening, we bring you insights from top financial experts, decode the latest trend, answer your burning questions on saving, investing, spending and everything in between, because you're on the Money Show. We believe one thing: you don't have to be a finance expert to take charge of your money. You just need the right advice. So let's dive right in, and before I welcome our guest on board, let's just flash our WhatsApp number and email ID where you can send across your portfolio queries, questions. This is a show where we do your life financial planning as well. So anything about investment, insurance, your spending or saving, you want expert advice or guidance, all you have to do is just send across your queries and we will get it answered on the show live. So let's begin. And lately, mid and small cap stocks have been the market's darlings, delivering stellar returns over the last year. But now there's a bit of a reality check coming in. Mid and small caps are currently trading 30 to 50% above their historical valuation averages. Now, that's raised an important question for investors. Are these segments still worth fresh investments, or have we entered a zone where valuations are running far ahead of fundamentals? To help us make sense of this and understand what lies ahead for small caps investors, joining us now is Ajay Khandelwal of MOSL and Sameer Shah of Investa. Ajay and Sameer, good evening and welcome to the Money Show. And Ajay, I'll begin with you. Let's start with the headline figure. Are small caps really that expensive right now? If so, how should investors interpret this particular valuation level?
Yeah, hi. Thanks. So small cap generally, I think this is the feeling that they are expensive. But when you consider the earning growth profile and when you compare it with other market caps, then you look at what is the PE ratio versus growth. Hmm. So I think based on PEG ratio, which we call it, they are trading actually lower than the large caps, practically in line with mid caps. And even historically, if you look at, I think PE will not convey the right picture, especially in terms of small caps, because the earning growth trajectory is very different from what it was in the past. I'll give you a couple of examples. For example, sectors like defense, cable, when they started showing growth in last 3 years, the earning growth was north of 25%, whereas the sectoral returns were almost 35 to 40%. So here both things have worked in favor. One is they started with a low PE base, and so re-rating happened, and then the earning acceleration happened. Whereas if I see, say, electrical equipments, they started with, say, 30% earning growth, and the return is also commensurate to that earning growth. So in small caps, what is important is that earning growth, that upgrade cycle needs to be there. And then if you start with a lower PE base, then you get benefit of both PE re-rating plus earning growth. But if you start with a, say, average PE or maybe a little higher PE, then all you can expect is the earning growth returns. So what is more important is that earning growth acceleration has to be there. So I think that is what determines the stock small cap returns. And in last 1 year, I think because of the challenges, some of the good sectors where now earnings kind of subdued for last 1 year, their returns have been subpar. But by and large, I think market has been very decisive in that phase.
Absolutely. One more question to you, Ajay. Now, given the premium, you being involved in the fund management also, what level of margin of safety do you now require before initiating new positions in this particular segment and fund then?
So, see, Kavita, what we look at is that whether the sector is seeing earning upgrade or not. That is actually very important, because what happens is generally higher PE uh, is a function of what kind of earning upgrade and longevity of earning is expected. So, for us, what is important is that if we are seeing tailwinds in the sector, if we are seeing that earning upgrade are happening more than what is street is expecting, then we are very comfortable with it. So our framework is little different. We believe, I think we've spoken before also, the QGLP framework. For us, what is important is that earning upgrade should happen. And in terms of margin of safety, see, we look at when you initiate a position, you obviously look at all these relative valuation with respect to their own history. So there, wherever we see that now earning tailwinds are there, we actually try and be before the market to capture those kind of sectors and stocks. So at this point in time, I think financials are doing well. And that is where I think we are focusing on. The domestic consumption is something where, because certain sectors and stocks have not given any returns in the last 1 or 2 years, so we are focusing there.
All right, so I'll come to you and we'll discuss more about the fund also and its exposure, sector specific, and the kind of risk reward ratio that investors also should be aware of. But then before that, Sameer, what explains this kind of investor appetite despite valuations being stretched? Even if we look at the monthly numbers that we get from Amphi also, mid cap and small cap has not seen a negative territory number, but then yes, there has been a regular spike in numbers of inflows if we talk about that. What according to you actually shows this continued interest among investors?
So, good evening, Kavita ji. First, thank you so much for having me today on your show. So, basically, if we talk about investor sentiment over a period of time, Indian investors have become little matured, and they understood a basic thing, that is small cap or maybe mid cap investments are not designed to create wealth over a period of time. It's not like no, they invest today and they'll get the return. So they understood that they have to stay invested for 7 to 10 years, and they also understood that like no, the small cap and mid cap, particularly this segment, are not gonna deliver consistent return year on year, right? So I guess that is perfectly fine with them, and they understand like no, phase correction and sideway markets are like no, sideway market movements are a part of a natural growth and a growth cycle. So I am like no, this I guess this is the stronger foundation for our equity market, and the investors have become matured, and that is somewhere like no, that is also helping, or maybe that is also translating, the numbers are not decreasing, and even they are not redeeming their investments.
All right, this is actually despite strong inflows into equity, mid and small cap returns have been comparatively weak. But then let's talk about the portfolio composition. And Ajay, I would like you to elaborate more on that. And then we'll take a take from Sameer as well on the MOSL small cap fund. So yes, what's the sector specific exposure like? Where are you overvalued, and where have you zeroed down your positions?
I think the portfolio is well diversified. Most of the companies are actually leader in their own domain. For us, what is important is that most of these companies have extremely healthy balance sheet. Now, in last 1 year, because of the external challenges, what we have focused on is that we have tried looking at companies which are actually coming out of capex cycle now. So they have these large facilities they have put up, and now finally they have commissioned. So it will start reflecting in revenues now. What happens during this phase is that generally, because the earnings are depressed because of interest payouts, depreciation, you see that optically they look expensive, but once that balance sheet strength start translating into P&L, you see the acceleration earning. So one is, as I said, these kind of stocks we are looking at. Second is we are looking at import substitution kind of stories, because that is where I think the demand is robust. There is clear value proposition. In terms of sectors, I think recently where we have added in last 6 months, our position is financials, domestic consumption names, and certain sectors which we always like healthcare, capital goods. Some of those sectors we are still holding on to it. So in last 1 year, there have been few changes in the portfolio, but by and large, the philosophy remains the same.
Any tactical shifts, Ajay, any tactical shifts that you can talk about that the portfolio composition has taken recently?
Uh, so see, we started looking at IT now because IT, for example, has seen because of the challenges in US, the order book inflow was little weaker than expected. But I think that is coming to an end in next 6 months. We believe at least the inflows from certain sectors where IT has large dependency, for example, financials, retail, manufacturing. Globally, some of those things will settle down and budgets will be formalized by Jan Feb. So we are looking at IT as a sector now because valuations are also very supportive. These are good companies, generate healthy cash flows. So that is one thing. And as I said, financials and some of these manufacturing companies which are coming out of capex cycle, this is where we have focused on. And in terms of paring down position, some of the manufacturing names, capital goods name, where we see now that order inflow is kind of slowing down. That is where we have pared down our position.
Got it, got it. All right, Sameer, let's also talk about the fund in your view as compared to the peers and other fund houses, small cap funds, and also in terms of returns. I know we should not be looking at return because talking about a long-term investment out here, but then, from an investor's perspective, returns are really important, and especially when we compare not only to the benchmark but also to the peer category.
So, Kapitaji, what we observed is like, the first I'll highlight the a few good point about the this fund. The portfolio has a lower churning ratio, say as compared to their peer. It has only 57% portfolio turnover, which is like in the if we talk about the small cap category side, which is lower. Then the second part is the cost efficiency. If we talk about this fund, say if customer is investing direct, then the expense ratio would be around 0.62. In this category, this is also compared to peer, it has a very lower to moderate. You can consider that that kind of cost is there, right? Expense ratio is there. The third point, which I would definitely like to highlight, Ajay just said, QGLP, which is a distinct investment style. And I must say that quality, growth, longevity, and price framework ensures that those who actually wanted to invest, it can definitely for if he is looking for long term investment, then trust me, this fund has a strong alpha generation potential. So these are the 3-4 points which I would like to highlight. Apart from that, one while investing, investor has to keep couple of points in his mind. First is this is best suit for aggressive long-term investor. So if investor is not long-term investor and if he doesn't want to take high risk, then I would suggest he could stay he could decide some other fund. And the another thing which I would like to say here is this fund has just launched in December 2023, so it has it is in very early stage to recommend, though the performance is very encouraging. The third point which I would like to highlight is when the investment style is QGLP, then the turnover ratio is 57%. Though it is compared to segment, it is low, but keeping this investment pattern, I feel it is moderately high. So these are the 3-4 point which investor need to take care before selecting this fund.
So it's a buy call, Sameer, from your end?
Yes, certainly.
Okay. All right. One last question to you, Ajay. Small caps, expensive but justified, or priced for perfection? What would you like to help our investors understand this particular category now?
So, Kavita, see, how we look at is that within small cap, we only talk about index and index PE, but there are so many sectors and subsectors in small cap. And our focus is generally on picking those sectors and stocks where we believe that the earning cycle is turning. As I gave you some examples, and I can give you one more. But generally, the focus is always picking on those sectors where we see earning improvement. Index headline valuation does not actually convey the right picture because we don't talk about when we compare it with historical averages, we don't talk about the earning growth, we don't talk about the return profile, we don't talk about the cash flow generation, the balance sheet health improvement, the debt to equity. For example, small caps are at, I think in 10 years, this kind of debt equity level is never seen in small cap. So these qualitative factors determine a lot about valuation. So when you consider all of it, and finally, as I said, price earning to growth, that ratio, if you look at, I think the index and some of these sectors and stocks are very attractive from that perspective.
Sure, sure. All right, Ajay, that will be all. Thank you so much for joining in today and not only talking about the fund that you handle, but also helping our viewers understand this particular space much better. Thank you so much. And Sameer, request you to stay on because it's time for a short break, but then post that we'll be continuing with Sameer, who will be answering your portfolio queries questions.